Hello and welcome back to Think Wealth 6789. I work a normal 9 to 5 here in Singapore and I invest on the side just like many of you. I am not here to sell hype, chase hot tips, or predict the next overnight winner. Instead, this channel is about thinking clearly, staying calm, and making better long-term decisions, especially in volatile years like 2026. Today's video is about something very speculative. How to spot high quality stocks in 2026 before everyone else does. Not which stock will go up tomorrow, but how to recognize businesses that can survive uncertainty, compound quietly, and still be standing years from now. Let me start with an uncomfortable truth. The last decade trained investors to believe almost anything could go up. Cheap money covered mistakes. Growth hide weak fundamentals. But 2026 is different. Capital is no longer free. Investors are paying attention to profitability, durability, and cash flow again. And when markets change like this, something important happens. Great businesses separate themselves. Average ones get left behind. So the real question becomes, how do you tell the difference? High quality does not mean famous brand, popular ticker, or stock that went up recently. A high quality stock is simply a high quality business, one that can raise prices without losing customers, survive bad years without begging for capital, and keeps generating cash even when growth slows. And most importantly, it performs consistently, not perfectly. So, how do we measure that? When I evaluate a company, I focus on 3 signals, not 30, not complex formula. Just 3 things that repeatedly show up in long-term winners. Number 1, a wide economic moat. Number 2, consistent return on invested capital over many years. And number 3, reliable, resilient cash flow. Let's break them down slowly and clearly. A wide moat means competitors cannot easily take customers away. This usually comes from network effects, switching costs, brand trust, regulatory barriers, and scale advantages. For example, think about MasterCard or Visa. Merchants don't casually switch payments network. Banks don't rebuild global infrastructure overnight. Or Microsoft. Once an enterprise runs on its ecosystem, the cost, financial and operational, of living is enormous. A moat doesn't mean that a company grows fast every year. It means it stays relevant even when conditions change. Ask yourself, if this company disappeared tomorrow, would customers struggle? If the answer is yes, that's a moat. ROIC stands for Return on Invested Capital. In simple terms, it answers these questions. For every dollar a company invests, how much value does it create? What matters is consistency. Anyone can have a great 1 year. High quality businesses deliver strong return on invested capital across good years and bad years. For example, healthcare leaders like United Health Group, global platforms like Alphabet or Microsoft. They didn't just perform during booms, they stayed efficient through inflations, rate hikes, and economic slowdowns. That tells you management know how to allocate capital intelligently. Revenue can be managed, earnings can be adjusted. Cash flow is harder to fake. High-quality companies generate real cash year after year, enough to reinvest in the business, pay down debt, buy back shares, and even survive downturns without panic. This is why consumer staples like Costco or Coca-Cola behave defensively. They don't need perfect conditions to function. They sell everyday products, collect cash, and keep going. In volatile markets, cash flow is oxygen. And not all stocks behave the same. High-quality growth stocks grow earnings steadily with moats. Cyclical stocks depend heavily on economic cycles, and speculative stocks rely on future breakthroughs. There's nothing wrong with speculation, but it must be separated from quality investing. For example, some investors believe robotics or AI infrastructure stocks could be the next big wave. I do. Others prefer data-driven platforms like Palantir. That's fine, as long as you know which bucket you are in. Quality investing is about what survives, not what excites. As a Singapore-based investor, buying US stocks means you are exposed to the US economy, the US dollar, and global earnings cycle. High-quality companies help reduce business risks, even if markets fluctuate. When you own strong global businesses, you are not betting on one country. You are owning cash flows from across the world. That's powerful. One of the biggest mistakes I see is spreading too thin. I did that before. Owning many average companies doesn't reduce risk. It often hides it. High-quality investing is about fewer decisions, deeper understanding, longer time horizons. You don't need to catch everything. You just need to avoid obvious weaknesses. So, before buying anything, pause and ask, does this company have a moat I can explain simply? Has it delivered consistent return on invested capital over many years? Does it generate real, durable cash flow? If even one answer is unclear, wait. Patience is part of the strategy. High-quality stocks often look boring. They don't triple overnight. They don't trend on social media. But quietly, year after year, they compound. And by the time everyone notices, then easy part is already gone. The best investors don't think like traders. They think like owners of businesses. If you wouldn't want to own the company for years, why own the stocks for minutes? If this framework helped you think more clearly about investing in 2026, please like the video and subscribe to Think Wealth 6789. Here, I focus on calm, logical investing without noise and hype. Thank you for watching, and I'll see you in the next one. Bye!